they passed the CARES Act on the 27th, we've pretty much received daily additional guidance, answering questions about certain things that were left unclear in the act. And so I believe the IRS is frequently asked questions went from 5 questions on the first day to 40 questions within 4 or 5 day period, I believe. And so that's the type of uncertainty that was created when these acts were passed. But you can't blame them for trying to hurry and get this stuff out there and trying to help the folks. As Ricky mentioned, this is an evolving situation, and the information that we're going to be giving you today is pretty fluid, and it's as good as today. There's certain specifics that we may go over that could change this afternoon or later this week, and so just keep your best practice is probably to consult with your tax advisor or just stay on top of the news of what's going on. But we'll go through and the best we can today and kind of go over what the rules are as they stand today. So probably the most popular portion of the CARES Act was the infamous PPP loan, Paycheck Protection Program loan. Okay, what made this loan so popular wasn't the low interest rate of 1%, no need for collateral, no fees involved in getting this loan, no personal guarantees, and you didn't have to establish that you had to get credit or you couldn't get credit from another institution, a lending institution, which is most of the time the case when you're applying for an SBA loan. In this case, even though all those aspects of the loan were attractive, the main purpose, the main reason that this loan was so popular was because of the forgiveness. If you spent the loan proceeds on specific items, you could have this loan completely forgiven, and that's what caused the rush of the businesses to go and try to obtain these loans. So, who is eligible for these loans? It's businesses or nonprofits with less than 500 employees, or there are specific exceptions for certain businesses that use an NAICS code of 72. And those are the accommodation and or food service businesses. So if you have a restaurant chain of several locations, you could still qualify even though as a whole you had more than 500 employees. But if by location you had less than 500, you could still qualify for this type of loans. The PPP loans were available or are available from February 15th to June 30, 2020, or as long as funds last, whichever comes first. Now, when the CARES Act was passed, it was passed on March 27th, and by April 3rd, the banks were already beginning. That was the first day that you could obtain a PPP loan from your bank. And so everybody rushed on that weekend to try to get their applications in, and I would say, what was it? Well, about 10 days. About 10 days later, the first phase of $349 billion that was allocated to this first phase of the PPP program was completely exhausted. So Congress acted again and extended and authorized another $310 billion to the phase 2 of the PPP loan program, which is currently underway. As of the weekend, the SBA has announced that $175 billion of the $310 billion has already been issued. So that means there's only $135 billion left in the program. So if you haven't already applied and you're eligible, you probably need to hurry, because I think that $135 billion is probably going to last. If by Friday it's not completely gone, I would be surprised. So So the way, how do I get that loan, and how is that loan, the loan applied for? The maximum loan amount that you can receive in this program is, you have to figure your average payroll cost for the previous year in 2019, and you multiply that by 2.5 times. And so and that would be your maximum loan that you could obtain, up to the maximum of 10 million. So in order to get this loan, how do I get it? Well, you have to apply at your bank. We would suggest that you start with the bank that you currently have your business checking account with, or you have a relationship with that bank. You have to provide payroll information in order to calculate the maximum loan amount, and you have to make 3 important assertions with that loan application. The first being that the uncertainty of the current economic conditions makes the loan necessary to support the ongoing operations of the borrower. The second, that the funds will be used to retain workers and maintain payroll, or make mortgage payments, lease payments, and utility payments. And the third, that the borrower does not have an application for a loan under Section 7A of the SBA for the same purpose, and has not received another Section 7A loan for that same purpose from February 15th through December 31st, 2020. So at the beginning of the loan program, everybody was easily checking those 3 boxes and going on their way and getting their applications in, and some of them were quickly getting funded. And because I want to just point out and pay special attention to that first assertion, that the uncertainty of current economic conditions makes the loan necessary to support the ongoing operations of the borrower. Considering the unknown effects of the pandemic, I think every business that wasn't funded or didn't have a lot of liquid assets could easily make that assertion without thinking twice about it. And so the rush to go get what you could was definitely in place. So what happened was, regarding that first assertion, a lot of word got out that several big, large public companies received PPP loan proceeds, when obviously that wasn't Congress's intent for the big public companies to get this type of loan. It was for the small and for those that really needed it. And some of the public companies like Ruth Chris's Steakhouse and Shake Shack and even an NBA team by the Los Angeles Lakers received PPP loans, which definitely wasn't the intent of Congress. So there was an outcry, and everybody, media got involved, and so therefore those big companies that got the loans were allowed to pay the money back without any consequence, because they obviously, in the eyes of Congress, in the eyes of the public, did not need that loan for them. So just as you apply for these loans, don't take the assertions lightly. Obviously, that first assertion is basically if you can justify that you need the loan because you don't think your business is going to make it if you don't get it. That's something that they're scrutinizing a little bit more now than they were in the beginning, and so just keep that in mind. So you fill in your application, you get your loan. Now what? Well, now it's all about the forgiveness. You have to. What we're going to point out here is just certain aspects of the Paycheck Protection Program that you need to keep in focus in order to maximize your forgiveness on this loan. You have 8 weeks from the date of funding to spend the money, and the acceptable use of the funds are payroll costs and related group health benefits, interest on any mortgage obligation, rent, utilities, and interest on any other debt incurred before February 15, 2020. Okay, so In addition, we also think it's a best practice that you keep a separate bank account to keep track of these loan proceeds. That way, when it comes time to apply for forgiveness with the bank, you can show all the distributions or all the withdrawals and all the transfers of money that are for these specific purposes. It makes it a little easier. We feel like if you keep it in a separate loan, in a separate bank account, you can easily trace where the money went and what it was used for. And so please keep that in mind and practice that if at all possible. Other aspects of the loan program that affect forgiveness is let me find my place here on my notes. The payroll costs during the 8-week period can't be reduced more than 25%. That affects your loan forgiveness. Okay, so if during the 8-week period your payroll costs drop more than 25% compared to the 8-week period, compared to the quarter before the 8-week period began, that will affect your loan forgiveness. In addition, any reduction in employee headcounts of full-time equivalent employees during the 8-week period will also affect your forgiveness if you compare those full-time equivalent employees during the 8 weeks to those 2 periods listed there on the slide, the first 2 months of 2020 or February 15, 2019 through 6/30/19. So if you see a drop in payroll costs of more than 25%, there's a reduction in your forgiveness. And if you see a drop in employees during the 8-week period, then that also could affect your forgiveness. And right there on the slide,
Javier, I've got a question I want to interject here, and this is coming from someone online.
Okay.
So they received a PPP loan. Are they required to rehire all the employees that were during the accounting for the amount, or can they hire only the full-time and not have to hire the part-time? So I guess the question is in calculation full-time equivalent, or is it full-time equivalent plus the part-time employee?
No, you don't have to rehire if you get the PPP loan, but again, it will affect the amount that's ultimately forgiven. It doesn't mean that you'll have to, you don't get anything forgiven, but it will have an effect on the amount that's forgiven if you see a drop in full-time equivalent employees, not necessarily the part-timers.
Part-time doesn't count, but full-time equivalent counts.
Well, part-times could have an effect in the formula, because you're having to add up the full-time equivalents, which are those that are working 30 hours or more, and those that are working 30 hours or less, the part-time, you add up their hours and then divide by 40 to come up with a full-time equivalent. So you have to kind of calculate what you have in full-time equivalent employees during the 8-week period by using those hours they work, and then compare that to the either or of the periods that are listed there.
And then here's a follow-up question to that. If some of our employees can't or don't want to come back to work, can we hire a new one who would comply with the total count required to get the forgiveness of the loan?
Yes, it doesn't have to be the same employees. You just have to restore the employee amount. There is a time frame that right now I think is officially right now it's June 30th. If you hire your employees or hire back employees by June 30th, then this particular reduction or this particular computation is not applicable, because you restored your workforce to what it was before the 8-week period. Okay. Now, one other item I want to, those are good questions, thank you. But one of the other items that I wanted to talk about in regards to the Paycheck Protection Program, throughout the program, one of the attractive aspects of the loan program was that the debt forgiveness was not going to be taxable. And that was, usually when you have debt forgiven, it can be taxable to the businesses and its income as debt discharge. But in this case, they were telling everyone that it was not taxable. Now, the IRS recently came out with a notice this past Thursday that said that even though the income was not taxable, the expenses that were paid with the loan proceeds would not be deductible, which basically means that it has the same effect as the income being taxable. So the IRS came out with that notice here recently, and since then we have gotten some information, and that's the rule right now, but we have gotten some information that the AICPA and other politicians are starting to maybe think about changing that, or AICPA is trying to lobby that should be changed because that wasn't Congress's intent, and it was to help the businesses get back on their feet and not necessarily not have the expenses deducted after all. We agree as tax people and that normally if you're paying something with tax exempt income, the expense is usually not deductible. But in this particular case, these are unique circumstances, and we'll see what Congress decides or what gets changed here within the next few weeks. Applications, the 8-week period, or the covered period for the loans doesn't end until June 30. So maybe by then we'll have additional guidance regarding whether the expenses that were paid with these loan proceeds are actually going to be deductible or not.
So we got another question here. Can you for the PP funds to the expenses paid before the funds were available, or do they have to be spent only after you receive the funds?
I think the rule is that the funds, there's a little bit of an uncertainty in regards to paid during the 8-week period or incurred during the 8-week period. Right now, we think it's the safest to make sure that the money is spent during the 8-week period and not before and not after, just to be safe. Again, we could get further guidance here within the next couple of weeks that says as long as the expenses were incurred during the 8-week period, if the money was spent after the 8-week period, but it pertains to expenses that incurred during the 8-week period, that they could apply. But for right now, our suggestion is if you have the proceeds, spend it on those specific items during the 8-week period just to be safe. Okay, good question. Go to the next slide.
Got one more question real quick here.
Sure.
And this is one of those fundamental questions. How do you calculate full-time equivalents, by the week, month, or pay period?
It's the hours per week, and so you take the hours that are being worked by all employees, and taking 30 hours, and all those employees that are working. The full-time equivalent employees are any employee that's working 30 hours or more. For anybody that's not working 30 hours or more, then you add up all their hours and you divide by 40 to come up with the full-time equivalents for all those employees that are working less than 30 hours. So that's how you come up with your total full-time equivalents for the specific periods. It's on a weekly That's on a weekly basis. Let's take a real quick example of the forgiveness computation as it stands right now. XYZ company applies and receives a PPP loan for $100,000. During the 8 weeks after receiving the loan, XYZ spends $60,000 on payroll costs and $25,000 on rent and utilities. The rule is that no more than 25% can be spent on non-payroll costs, which is rent, utilities, and mortgage interest. So in the above example, you would think that because I didn't spend more than 25% on non-payroll costs, I only spent $25,000 of the $100,000 that I received, I should be okay, and all of that would be forgiven up to the extent of $85,000. all of the payroll costs would be forgiven. And then because I didn't exceed 25% on my rent and utilities, I would have forgiveness of the 25,000. But the way the CARES Act is written right now, and we could get further guidance, and they could say that this wasn't the intent, but the way it's written right now is you can't spend more than 25% of the loan, or more than 25% of the forgiven amount on rent and utilities. Or in other words, when you come up with your total forgiven amount, the amount that you spent on rent, utilities, mortgage interest can't exceed 25% of the forgiven amount. And so in order to figure out how much of the forgiveness will apply to those costs that were non-payroll, we kind of have to back into it. And so in the example here, we're taking the $60,000 that was paid during the 8-week period for the payroll costs and divided that basically by a third to come up with $20,000. That is the maximum amount that could be forgiven of non-payroll items. But when you add the $60,000 plus the $20,000 that was forgiven, you have a total forgiveness amount of $80,000, so that the ratios come out in accordance with how the law is written. That may have not been the intent of Congress, but as it stands right now, if you read it in the CARES Act, that's the way the computation and the forgiveness is calculated. And this is assuming that none of the other issues in the previous slide regarding full-time equivalent employees or payroll costs have been reduced. So assuming those aspects of forgiveness are not an issue that we talked about on the previous slide, you would still not get everything forgiven that you spent in this particular example. And in this example, the XYZ company would still owe $20,000 back as a loan. Now, again, it's not the end of the world. It is a kind of a sweet deal on the loan in regards to, it's guaranteed by the SBA. There's no personal guarantee, and it's a 1% loan that you have 2 years to pay it back. So the idea is to try to get most of it forgiven, but you have to keep these things in mind. It's not as easy to have 100% of the loan forgiven as most people think, unless they're just going to spend it all on payroll and they have enough payroll to cover the entire amount of the loan proceeds. So I don't know if there's any, is there any, where's the little arrows? We're going to move on to the next act that will.
Javier, I got one more question.
Go ahead.
So the question is, if you gave somebody a raise during this loan period, would that count as part of the forgivable loan?
Yes, any raises or increases in pay would be allowable, with the exception if you have to exclude, well, up to a certain extent, because the salaries in excess, if you were to annualize the new salary of the employee and it would exceed 100,000 in total compensation on an annualized basis, then you'd have to exclude some of that pay. But as long as his total pay, even with the raise, is not more than 100,000 per year, then it would qualify.
Okay. Thank you.
Okay, so everything that we've just went over regarding the PPP loan was part of the CARES Act. Okay, what we're going to talk about here is a part of the Families First Coronavirus Relief Act. Okay, so that was a little what this act did was basically expand an act that was already in place by the name of Family Medical Leave Act, which we've had since 1993. And what it did is it added 2 weeks of sick leave, 2 weeks of sick and 10 weeks of family leave for employees that were out of work or couldn't work due to COVID-related reasons. This particular sick and medical leave is mandatory for employers with less than 500 employees. There is an exception for employers that have less than 50 employees, but you have to be able to ascertain that providing the leave for these particular employees would have a detrimental effect on your business and would not be viable for their business as a going concern. So there is some guidance there on how to do that, but basically it applies to employers of between 50 and 499 employees. Okay, it does not. This particular leave has to be requested, and it's mandatory to be paid to employees if they meet the certain requirements. So in order to, and it does not apply to businesses that have been shut down. Okay, leave is not required to be paid to employees because they've been shut down and they can no longer work. They have to be either sick or taking family leave for a particular reason. If you do get those requests, then the law enables the business to take a tax credit, 100% tax credit, depending on the employee situation. If the employee is the sick person and is being quarantined or is been exposed and their doctor is telling them that they have to be quarantined for the 14 days, or they have symptoms, then you pay that employee, or you're required to pay that employee at their regular pay rate, and the IRS will allow a tax credit of up to $511 per day for that employee for 10 days. If the employee is not the sick person, the person that is sick, but is caring for someone that is sick or quarantined, then the credit allowable for that employee is $200 per day for 10 days. But that employee is only eligible for 2/3 their regular pay. If you don't have that case, then you have family leave, which is for 10 weeks. And that is from what we can tell, that is put in place for those folks that have kids or children under the age of 18, where their school has been shut down and they don't have anybody to care for the child, and they cannot work or telework during this period, and so that there's a credit that's allowed for them as well. These credits are not affected by the PPP loan, and the income is increased by any credit allowed. These are fully refundable credits. The other credit that's allowed and that was created under the CARES Act is something that's I'm not going to spend a lot of time on, because now that businesses are starting to open up a little bit, maybe it's not as applicable, but in this particular credit is available to those businesses that have been shut down during the pandemic. And in order to be eligible for this credit, you either have to be shut down or you have to see a decrease of 50% in revenue over the comparable quarter in the previous year. So this allows a 50% of wages paid to employees up to $10,000 per employee for a maximum credit of $5,000. The amount of the credit that you're eligible for depends on the number of employees that you have, which is either over 100 or less than 100. Now, the unique point on this credit is if you receive a PPP loan, you cannot take this credit. And income is increased by the amount of the credit taken. And again, this one is fully refundable. I just sped through that one a little bit because I want to leave time for my other two colleagues here before closing it down. So any questions on that before we move on to the deferral of payroll taxes?
I've got a question here from one of the participants. If the employer has a retirement plan for employees and his match contribution is that considered part of the 75% for the payroll?
The employer match of retirement plans, yes, is part of the, is eligible for the 75% payroll cost. Okay, now I'm gonna pass the baton here to Joel Fernandez, who's a tax manager here at BML, and he'll be going over the deferral of payroll taxes that is available under the CARES Act as well.
Thank you, Javier. I'm going to cover just a general rule of the deferral payroll taxes. And like Javier mentioned, the CARES Act, the CARES Act allowed employers, in this case, in deferral payroll taxes, the CARES Act allows employers to defer the deposit and payment of employer share of Social Security taxes, which in this case is the 6.2% of the FICA taxes. And the effective dates are March 27, 2020 to the end of the year. Now, these taxes are deferred all the way to December 2021, 50% of it. The remaining 50% of it is deferred to December 2022. Now, as all these rules interact with the PPP loan. So what's the interaction of this rule with the PPP loan? Well, the employer is not allowed to defer deposits or payments if they have a PPP loan that's forgiven. So now the key word here is forgiven. So what happens between the funding date and the forgiveness date? So if the loan has not yet been forgiven, then the employer can still defer the deposits and the payments on the employer's share of Social Security taxes. Once the loan is forgiven, the employer is not allowed to defer these taxes. However, the amount that was deferred between the funding date and the forgiveness date is not going to be due until the original dates of the deferral, which is December 2021 and December 2022. So now, these are the interactions of the PPP loan and the deferral payroll taxes, and this is after all those other credits that Javier mentioned have been applied. So now, what happens with the self-employed individual? The self-employed can defer 50% of the self-employment tax, similar to December 2020 and December 2022. Yes, will not have to make estimated payments again. Again, on the deferred self-employment taxes, there's no penalty for failure to make an estimated tax payment for the 50% of those taxes. So now I'm gonna go over the extended deadlines. Which do you all have any questions on that? This is fairly simple. This is is very straightforward. The other credits that Javier covered, they're a little bit more. They have more rules than this one. Okay. So the extended tax deadline is that all tax returns are now due July 15. This includes the payments as well. And now also 2020 estimated tax payments for the first and second quarter are now due July 15, 2020. So now this is, before the first quarter payment was due 4/15 and the second quarter payment was due June 15. Now this is making it making it very simple for us to have all deadlines be July 15, 2020. So now I'm going to pass it on to Rebecca so she can cover more of the tax aspects of the act.
So thank you, Joel. So just in case you haven't been able to pick up on it, accountants are not going to have a summer this year. So, pretty much June 1st, I'm going to start sleeping in my office. Okay, so the next item I'm going to touch on, and I'll try to go fairly quickly on these items. So Congress made some sweeping changes to retirement plans. A lot of the penalties. So one of the big items was if you take money out of a retirement plan before you're 59 and a half, there's usually a 10% penalty on the retirement plan distribution. In addition to that, you're required to withhold at least 20%. Congress said, no, we're not going to have that 10% penalty, and if you don't want to withhold that 20% at that time, you don't need to withhold. So, and the other item is that, this to me is a big item, is basically IRAs. You can now get a loan from an IRA. In the past, if you put money into an IRA, you couldn't take it out unless it would be taxable. Right now, if you take money out of your IRA, you have 3 years to pay it back. If you think you can pay it back, if you think I'm not going to be able to pay it back, you can pay your taxes over the 3 years. At this point, my understanding is that if you take money out in 2020 due to COVID reasons, up to $100,000, you will get taxed ratably over the next 3 years on that distribution. And at any point, you can put that money back in over the 3 years. So like I said, this is big as far as IRAs because, in the past, you wouldn't have this option. The other big item is on no required minimum distributions. Once you meet 70 and a half, you're generally required to take a portion of your retirement plan out, whether it be an IRA, simple IRA, 401k. What this is doing is saying you don't need to take it out. So if you'd prefer it just staying there for this year, go ahead. So are any questions on that? No? Okay, great. So a couple of years ago, when I was doing presentations on the Tax Cuts and Jobs Act, Congress made all these sweeping changes, all these tax deductions that previously weren't there. I used to make the joke that Congress give it and they take it away. Net operating losses is one of those items. So the Tax Cuts and Jobs Act eliminated the carryback of net operating losses. The CARES Act came along and said you can carry back for 5 years. So if you had a loss in 2018, 2019, or 2020, you can carry it back for 5 years. And then the Tax Cuts and Jobs Act only allowed 80% of income be offset by your NOL. And the CARES Act is saying, no, you can offset 100%. So for a quick example of that, let's say you had $100 of income in 2019, before CARES Act came into effect, you had $100 of income of 2019, you had $200 carried over from a prior year of NOL. You'd only be able to offset that $100 with $80. Now that Congress is saying you can offset the whole $100 on that. The next item is, let's see, qualified improvement property. So your accountant's going to be really happy with this change. So prior to, going back before 10 years ago, basically, if you made an improvement to your property, it would be qualified as 39-year property, which means you would have to depreciate it over 39 years. Tax Cuts and Jobs Act, as well as some other acts along the way, said, well, if you make changes to the interior portion of your property, which means you're not making changes to an escalator, elevator, you're not, any load-bearing walls, so to speak, or any load-bearing parts of the building, or you're not making your building bigger, those could be considered qualified improvement property. So what Congress did is said back in Tax Cuts and Jobs Act to say, okay, this is qualified improvement property. What they didn't do at that time is give it a shorter depreciable life. At that point, when Congress did that, they left it with a 39-year depreciable life, which basically meant that it was not eligible for bonus depreciation, which is accelerated depreciation, first-year write-off. So what the CARES Act is doing is saying, okay, so now it's going to be considered 15-year property. If you make an improvement or you make a change to the interior portion of your building, it will be considered 15-year property, which will make it eligible for bonus depreciation. A lot of people will say, well, what about, couldn't you just take Section 179? Yes, you could have taken Section 179. However, Section 179 was still limited based on your income, and it was limited based on how many improvements you made during the year, as well as, the type of income you had. So the big thing on that is you can amend 2018 or 2019 to take the deduction, or you can also do a change of accounting. The change of accounting is a little bit more, it does take a little bit more time to prepare that. However, depending on, what your investment was in 2018, 2019, it may be worth it. So I would definitely advise you to check with your accountant and see, what would make the most sense. The next item is going to be, there we go, charitable contributions. So generally, charitable contributions are an itemized deduction. So after Tax Cuts and Jobs Act, many people who would itemize were now taking a standard deduction. So they were no longer getting that charitable contribution. So what the CARES Act said was, we'll allow you up to $300 in deduction if you're not itemizing on your return. So hopefully, if you're able to, a lot of people will be making charitable contributions this year for that $300 deduction. The other item is under Tax Cuts and Jobs Act, the charitable contribution, as an itemized deduction, was limited to 60% of your income. What CARES Act came and did is said you can basically contribute all of your income. That would be a great position to be in. So that concludes our portion of the presentation. I know we've run a little bit more on time, but if there's any questions, we'll be happy to answer them.
Ricky, you want to say some things?
Yeah, just a few things. I know some of these topics for a lot of people can get really complicated. And what we hope we accomplish today, if nothing else, is getting folks familiar with maybe some of the terminology, and maybe walk away with at least some questions for their own, tax advisor, their CPA, who's ever advising them in their business. And I hope the folks that were out there were able to at least gather those buzzwords, the things that they need to be watching out for. Again, these are uncharted waters, unprecedented times. And I know businesses large and small are scrambling for information, and I hope we accomplish in providing them some information. Try not to talk like accountants, but sometimes we just can't help ourselves. But Steve, I want to thank you and the Chamber for allowing us to partner with you to help our local business community, and look forward to helping the Chamber and other endeavors as we all move forward together.
So I've got a couple of questions, if we wouldn't mind, real quick. So the first one is, this is a simple one. We really don't know when the forgiveness day is, right? I anticipate, just like it was bottlenecked at the very beginning of the PPP program, it's going to be bottlenecked at the end in terms of the calculating what the forgiveness is.
Right. It's going to depend on when you got your funding and when your particular 8-week period ends. And so therefore, once you submit your application to the bank for forgiveness, the bank, my understanding is the bank has 60 days to turn around and give you that amount. And so going back to what Joel was talking about, the deferral of those payroll taxes, you can still defer those payroll taxes even during the time from when you submitted your application for forgiveness to the time that the bank comes back and tells you the amount that's forgiven. So if the bank takes the full 60 days to give you the forgiveness amount, that gives you an additional 60 days to defer those taxes, those payroll taxes.
Another question we have is just on calculating the $100,000 limitation. The question is that a annual limit or is that a pay period limit?
No, it's an annualized limit. I know.
Another question is, if I buy an equipment for my business, can it be forgiven as part of the PPP program?
No. It's very, we go back to the assertions on the loan application. The loan application, you're asserting that you're going to use it for payroll costs and interest and rent and utilities. So you cannot use the loan. If you're not interested in the forgiveness aspect of the loan, that doesn't mean that you can go and use that loan for whatever you want, because you've already asserted on the application that you're going to use it for these particular items. And if you don't use it for those items, you could, be accused of committing fraud in regards to the banking industry.
Another question here, and this is a little bit more of a technical. They say that they have a 500,000 square lease warehouse, and they sublease 35% of the premise to some customers in order to have their operations closer. The portion of the sublease square footage that is subleased, can they get payment from their customer applying as an expense to keep for that would go toward their loan forgiveness? I'm not sure if I explained that correctly.
Yeah, that's a very specific situation that I'd have to actually go and research to see if that applies. And I think it's beyond the scope of what we're talking about, of what we're going to be able to provide today.
Yeah, they can send us the question. We can maybe
we
talk
can.
about it.
Okay, and then another question we have is only this, in calculating the forgiveness part of the PPP program, do you include vacation and bonuses in that as part of the $100,000 limit? Does that make sense? So you got if you're limited at the 100,000, do you include bonuses on top of the 100,000 plus vacation time?
It's based off of regular pay. I mean, I think if the loan's intended to cover basically 2 months worth of payroll, and so whatever that comes out to be, if you're paying a bonus, that is fine as long as the bonus doesn't take you over the threshold of 100,000. And again, it's the annualized pay of the employee plus the applicable healthcare costs.
All right, Sally, I think we are at the end here. We don't have any more questions. If there are, you feel free to email them to us and we'll forward it on to Ricky and his team. But Sally, would you care to make any final comments? Oh, you got to unmute, Sally. Unmute.
Can you hear me?
We can hear you now.
Yes. I said thank you, everybody, for participating. And thank you, Ricky, and your group for a great presentation. That was a lot of information. Thank you.
Thank you.
So, Ricky, you'll be glad to know that you guys have the record so far as participants are listening in. You even beat Senator Cornyn. Congratulations. Thank you all for joining us. We will have our next one next week. We're working to get Dr. Jay Gonzalez with the school district lined up to do our next MCA Talks. We look forward to seeing you next week. And everybody, please stay safe.
Thank you, Steve.
Thank you. Ricky, call me, Ricky.
Thank you.
I will.
Bye.